Hi, welcome back. If you watched the silver market this week, you probably saw something that made you sit up a little straighter. Silver didn't just tick higher. It surged more than 5% in a single move, tearing through resistance levels that traders had been watching for weeks. And the fascinating part isn't just the size of the jump, it's what's actually driving it. Because this isn't a simple story about inflation fears or a weak jobs report. This is a story about oil, about tension in the Middle East, about the US dollar getting caught in the middle, and about a growing question that more analysts are starting to ask out loud. Is silver finally decoupling from gold and starting to trade on its own set of rules? Let's break this down from the beginning, because understanding why this move happened matters a lot more than just knowing that it happened. Over the past several days, tensions tied to the ongoing situation between the United States and Iran have escalated again. When geopolitical stress rises in a region that produces and transports a significant share of the world's oil, markets don't wait around for confirmation. They react immediately, and one of the first places that reaction shows up is the oil market. When shipping routes through the region feel uncertain, when there's even a hint that supply could be disrupted, oil prices tend to jump. And when oil prices jump, that ripple doesn't stay contained. It moves into bond yields, it moves into currency markets, and eventually it moves into precious metals. Now here's where it gets interesting, because oil and silver don't usually get mentioned in the same sentence. Gold and oil, sure, that connection is old news. But silver has quietly built its own relationship with energy markets, and it comes from two completely different directions at once. On one side, silver behaves like a traditional safe haven asset, similar to gold, moving higher when investors get nervous about geopolitical risk or when they lose confidence in paper currencies. On the other side, silver is a heavily used industrial metal, tied directly to solar panel production, electric vehicles, semiconductors, and increasingly, the build-out of artificial intelligence infrastructure. Think about it this way. Silver has one foot in the world of fear and one foot in the world of factories. When oil prices spike due to geopolitical tension, both of those forces can get triggered at the same time, and that's part of why silver's moves can feel so much sharper than gold's. Now this is important because a lot of new investors assume gold and silver just move together, like two dancers doing the exact same steps. For a long time that was mostly true, but 2026 has been a year where that relationship has started to bend, and this latest surge is another data point in that story. When oil shocks hit, rising energy costs tend to worry central banks about inflation. That pushes bond yields higher, and a stronger dollar usually follows. Normally, a stronger dollar is bad news for precious metals because it makes them more expensive for buyers using other currencies. Gold has felt that pressure. But silver, because of its industrial backbone, has been finding support even when the dollar strengthens, because industrial buyers still need the physical metal, regardless of what the dollar is doing that week. That's the decoupling people are starting to talk about. Let's talk about the technical side for a moment, because the chart pattern here matters just as much as the headlines. Silver had been consolidating for weeks in a fairly tight range, testing support levels repeatedly without breaking down. When a market does that and then suddenly breaks out with strong volume, it tends to attract even more buyers who don't want to miss the move. That's often called a breakout confirmation, and it can create a feedback loop. Traders see the move, they jump in, prices rise further, and short sellers who bet against silver start covering their positions, which adds even more buying pressure. This kind of chain reaction is a normal part of how commodity markets behave, and it helps explain why a single day's move can feel so much bigger than the news itself might justify. Here's what this means for the average person watching from the sidelines. You don't need to trade silver actively to understand why this matters. Precious metals often act like a stress gauge for the broader economy. When silver and gold move sharply, it's usually a signal that something in the background, whether that's geopolitical risk, currency concerns, or inflation expectations, is shifting in a meaningful way. Paying attention to these moves can help you understand the bigger economic picture, even if your only exposure to silver is watching the price on a screen. Now let's zoom out and talk about the supply and demand side of this story, because it's just as important as the geopolitical headlines. Silver has been running a structural supply deficit for several years in a row now. That means the world is using more silver than mines are producing, year after year. Industrial demand keeps climbing because solar installations continue expanding, electric vehicles keep needing more wiring and components, and the growth of data centers and AI infrastructure is pulling in more silver for electronics and connectors than most people realize. Meanwhile, new silver mine supply takes years to bring online, and most silver isn't even mined on its own. It's usually a byproduct of mining for copper, zinc, or lead, which means silver production doesn't respond quickly to higher prices the way people might expect. This is where the physical market and the paper market start to matter. Most of the day-to-day price action you see quoted comes from futures contracts traded on exchanges like COMEX, where enormous volumes of paper silver change hands every day, often far exceeding the actual physical metal sitting in vaults. For most of the time, that system works fine. But when physical demand spikes, whether from industrial buyers or from investors wanting real bars and coins, the gap between paper trading and physical availability can create tension. Some analysts watch registered versus eligible inventory levels on COMEX as a way to track how tight that physical supply is getting. When registered inventories, which represent metal actually available for delivery, start shrinking while eligible inventories, metal sitting in vaults but not committed for delivery, stay flat or shift, it can be an early signal of stress building beneath the surface of the market. Before we move on, it's worth bringing in the gold to silver ratio, because this is one of the simplest tools for understanding whether silver is cheap or expensive relative to gold at any given moment. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When that number is historically high, it often means silver has lagged behind gold and may have room to catch up if conditions favor precious metals broadly. When the ratio compresses quickly, like it has during sharp silver rallies such as this one, it usually signals that silver is outperforming gold in relative terms, which is exactly the kind of behavior that fuels talk of a decoupling. This ratio isn't a perfect predictor of what happens next, but it's a useful gauge that a lot of longtime metals watchers keep an eye on, especially during moves like the one we're discussing today. Let's pause here for a second. If you're finding this breakdown useful, it genuinely helps the channel when you hit like and consider subscribing, because it lets more people who are trying to understand these markets find this kind of explanation. No pressure at all, just something to think about as we keep going. Now let's talk about risk and the other side of this story, because it wouldn't be responsible to only focus on the bullish case. Sharp moves like this 5% surge can also unwind quickly. Geopolitical tensions can ease just as fast as they escalate, and if that happens, some of the safe haven buying that pushed silver higher could reverse. Oil prices could pull back if shipping routes stabilize, or if there's diplomatic progress, and that would remove one of the key pressures currently supporting this move. There's also the Federal Reserve to consider. If inflation concerns tied to oil prices push policymakers toward a more cautious stance on interest rates, that could strengthen the dollar further and create headwinds for precious metals broadly. Even if silver's industrial demand stays strong, markets rarely move in a straight line, and after a sharp single-day surge like this, some amount of consolidation or pullback wouldn't be unusual or alarming. It's simply how markets tend to digest a big move. It's also worth remembering that geopolitical situations like the one unfolding around Iran can shift quickly and unpredictably, sometimes escalating over a weekend and sometimes cooling off just as fast through diplomatic channels most people never hear about until after the fact. That unpredictability is exactly why chasing a single day's headline move can be risky, and why understanding the underlying framework matters more than reacting to any one price swing. There's also the question of how much of this rally is driven by speculation versus genuine underlying fundamentals. Futures markets can amplify moves in both directions, and a chunk of any single day's 5% jump is likely coming from short covering and momentum trading rather than a sudden change in the real-world supply and demand picture. That doesn't mean the move isn't meaningful. It just means it's worth separating the noise of a single trading session from the longer-term structural story around industrial demand and supply deficits, which tends to play out over years, not days. So how should you think about all of this without getting overwhelmed by headlines every single day? Here's a simple mental framework that can help. Picture silver sitting at the intersection of 3 separate roads. One road is geopolitical risk, which includes things like the US-Iran situation and how it affects oil and safe haven demand. The second road is monetary policy and the dollar, which includes what the Federal Reserve is doing and how that affects the cost of holding non-yielding assets like precious metals. And the third road is industrial demand, which includes solar, electric vehicles, semiconductors, and the broader technology build-out that keeps needing more physical silver every year. When traffic from all three roads picks up at the same time, like it has recently, you get moves like the one we just saw. When only one road is busy and the others are quiet, moves tend to be smaller and more contained. Watching which of these three forces is actually driving a given day's price action can help you understand whether a move is likely to be short-lived or part of something bigger. Looking ahead, there are a few different paths this could take, and it's worth holding space for more than one outcome rather than assuming certainty. If geopolitical tensions continue or worsen, and industrial demand keeps climbing at the same time, some analysts believe the structural deficit combined with safe haven flows could keep upward pressure on silver for an extended period. On the other hand, if there's a diplomatic resolution and oil prices ease, some of the recent gains built on fear could unwind, even while the longer-term industrial demand story remains intact underneath. A third possibility is more of a sideways grind, where silver holds recent gains, consolidates, and waits for the next catalyst, whether that's a Federal Reserve decision, a shift in the geopolitical picture, or new data on industrial demand. None of these outcomes is guaranteed, and anyone claiming they know exactly what happens next is overstating their certainty. What does this actually mean for regular people managing their own finances outside of active trading? For a lot of households, silver and gold aren't really about chasing a 5% daily move. They're about diversification and understanding how different assets respond to different kinds of stress, whether that's inflation, currency weakness, or geopolitical shocks. Watching how silver reacts to events like this can give you a clearer read on market sentiment more broadly, even if metals aren't a large part of your own financial picture. It's less about predicting tomorrow's headline and more about building a general sense of how the pieces of the economy connect to each other, so that when you do make financial decisions, you're making them with a clearer picture of the forces at play, rather than reacting purely to a headline or a single chart. It's also worth remembering that precious metals markets have always carried volatility, and that's true in both directions. The same forces that can produce a 5% surge in a single session can, under different conditions, produce sharp pullbacks too. That volatility isn't necessarily a flaw in the market. It's simply a reflection of how much information, fear, opportunity, and speculation all get priced in constantly, sometimes within hours rather than days. So where does that leave us? Silver just delivered one of its sharper moves of the year, and the reasons behind it are layered rather than simple. Escalating tension tied to the U.S. and Iran pushed oil prices higher, which fed into inflation concerns, dollar dynamics, and safe haven demand all at once. At the same time, the underlying structural story around industrial demand and a persistent supply deficit continues running in the background, giving this move a foundation that goes beyond just a single headline. Whether this turns into the beginning of a larger decoupling from gold, where silver increasingly trades on its own industrial and geopolitical logic rather than simply following gold's lead, or whether it settles back into familiar patterns, is something we'll only really know with time. What matters most right now is understanding the forces at play, rather than getting swept up in the excitement of a single day's headline number. Keep watching how oil, the dollar, and industrial demand interact over the coming weeks, because that combination is likely to keep shaping silver's next move. That's what's behind this latest silver surge, and why it's worth paying attention to. If this kind of breakdown helps you make sense of what's happening in these markets, consider subscribing so you don't miss the next one. Thanks for watching, and I'll see you in the next video.